Okay, everyone, we are going to review a few of the problems at the end of chapter 18, so you're familiar with this material. Actually, I'm going to start with problem 18.1, although you see problem 18.5 at first. So let me get down to it. There we go. So in problem 18.1, we have a couple parts to it. In Part A, during its first year of operation, the McCollum Corporation entered into the following transactions relating to shareholders' equity. The corporation was authorized to issue 100 million common shares. So remember, that's the most that they can sell. $1 par per share, that's the minimum liability of the stockholder. So we always want to make sure the shareholder pays at least par value. So in the first requirement, January 9th, issued. So the company sold 40 million common shares for $20 per share. So the company will be receiving cash, so we'll definitely debit cash for 40 million times $20 per share, $800 million. We just eliminated the 6 zeros. We credit the common stock account. Remember, that is a paid-in capital account. In stockholders' equity, we have two major sections: paid-in capital, which is where we keep track of all the amounts the company receives when it first sells a share of stock, and then retained earnings, where we keep track of the profits that are available to be paid as dividends. Common stock is a paid-in capital account that we only are allowed to store in there the par value. So 40 million shares times $1 par value will credit that paid-in capital account of common stock, 40 million. Any amount we receive above the par value is stored in another paid-in capital account called paid-in capital excess of par for 760. So it's an overflow. So both accounts are paid-in capital accounts. They appear in that section of stockholders' equity. But because the common stock is a par value, we're only allowed to credit the common stock up to the par value. On January 11th, the company issued 5,000 shares in exchange for custom-made equipment. The shares were recently traded on a stock exchange at $20 per share. So when we are purchasing a non-cash asset with our stock, we generally use the value of the stock as the purchase price, even if we know the value of the equipment or the land or building or whatever asset we're buying. The reason being is because the fair value of the stock is the most unbiased market value. So if the company doesn't trade their stock on a stock exchange, then we would use the fair value of the asset being purchased. In this case, we'll be debiting the equipment for 5,000 shares times $20 a share market value, or 100 grand. Credit the common stock for the 5,000 shares times the $1 par value, and the difference will be credited to that paid-in capital excess of par account, $95,000. So that is demonstrating how we sell stock. In Part 2, a new staff accountant for the McCollum Corporation recorded the following journal entries during the second year of operation. McCollum retires shares that it reacquires, restores their status to that of authorized but unissued. So on January 12th, when the company received donated land, they debited land and credited a paid-in capital stockholders' equity account called paid-in capital donation of land. Well, that's incorrect. The correct journal entry should have been a credit to the revenue donation of land. In the second journal entry, when they're they're purchasing back the common stock to retire it. They're going to retire it. They will debit common stock for the 2 million shares that are being retired. And we know that because they're debiting the common stock account for $2 million. So it's 2 million shares times $1 par value. But they don't debit retained earnings for the difference. They debit paid-in capital excess of par for the 2 million shares times $19. because they originally sold it for $20. $1 went into the common stock. Remember up above? The other $19 went into paid-in capital in excess of par. Well, when we are restoring that to unauthorized status, we want to decrease any paid-in capital related to the stock being retired. Now, we paid cash of $50 million. The difference between the $40 million that we originally received for the stock and the cash of $50 we had to pay will be debited to retained earnings. $10 million debited to retained earnings. Finally, and I apologize for how this looks. Let me see if I can fix it quick. In the final journal entry, it looks like they received cash of $26 million for the sale of stock. They credited common stock for $1 million. So it looks like they sold 1 million shares, $1 par value. And instead of crediting paid-in capital in excess of par, they credited paid-in gain on sale. No, we don't do that. So what is happening here is that these shares of stock up above that they sent back to unauthorized, they're now reselling. So we would do it just like, we would record it just like any other stock sale being sold for the first time. We removed the original amounts that we received when we sold this back up on January 9th. That's what we did on September 1st. Now, when we reissue it, it's like we're selling it for the first time. Okay, so those are some interesting journal entries and transactions. We're now going to move to problem 18-3, which is when a company reacquires its stock and maybe holds on to it to resell it, or they may hold on to it and then retire it. And that's when we put the common stock receives the label of treasury stock. So treasury stock is just a label we put on the common stock of a company when it owns its own common stock. Let's take a look. National Supply shareholders' equity include the following accounts at December 31st, 2017. So they have a common stock account. 6 million shares are issued at $1 par. Paid-in capital in excess of par, so the amount they received above $6 million when they originally sold this was $30 million, and then retained earnings has a balance of $86,500,000. National Supply reacquires shares of its common stock in 2 separate transactions, and then later sold shares. Prepare the entries for each of the transactions under each of these 2 assumptions. The first one being the shares are retired, and the second, it's accounted for as treasury stock. So in Part A, February 15th, the company reacquired 300,000 shares at $8 per share. So credit cash, $2.4 million. Debit, now the assumption in Part A is that we're retiring it immediately. So we'll take the 300,000 shares times $1 par value and debit common stock. Now, since the paid-in capital in excess of par is at $30 million for 6 million shares, the assumption is the excess of par amount is $5 per share. So we need to debit paid-in capital excess of par for $5 times the 300,000 shares. And then the difference between the cash paid of $2.4 million, 300,000 shares times $8, and the $1.8 million that they originally sold that stock at, $6 per share, is debited to retained earnings. So they've retired it. So we're going to stick with the retired journal entries. Then we'll look at the treasury. February 17th, they reacquired 300,000 shares at $5.50 per share. So on February 17th, again, they're going to credit cash for $5.50 times 300,000 shares, $1,650,000. They still will debit the common stock for the par value, $300,000, and the paid-in capital in excess of par for the $5 above par that it was originally sold for. So $1.5 million. In this case, the difference is credited to a paid-in capital share repurchase account. So they received, or I'm sorry, they paid $1,650,000 for stock they originally sold at 1.8. So they bought back, they paid $150,000 less than they should have. So they have a gain here. But we credit a paid-in capital account. So this is just like, this would go in the same area as common stock, paid-in capital in excess of par. But it's a special paid-in capital because it's a gain from repurchasing shares. The final transaction is now they sold 200,000 shares, at $7 a share. Well, debit cash, 200,000 times 7. It's just like they sold it for the first time. Credit common stock for 200,000 shares times $1, and then credit paid in capital in excess of par for 1.2 million. And it's the same understanding as we did in problem 18.1. When you buy the shares out of the market and immediately retire them, you're removing any cash and value related to them from your books. So when you resell them, it's like you're selling them for the first time. So that's when you retire shares. Let's take a look if you buy the stock out of the stock market with the intention of reselling it back into the stock market in the future. Well, when that's the case, you don't immediately retire it. We don't debit common stock. We debit in contra equity account. So this goes in stockholders' equity, and it does have a debit balance because it's a contra account. So we debit treasury stock $2,400,000 and credit cash. Par value, none of that comes into play here. It's just how much cash should we pay to rebuy those common stock, $2.4 million. We do the same journal entry on February 17th if we're accounting for this as rebuying it and not retiring it. Debit that contra equity account treasury stock for 300,000 shares times $5.50 a share, credit cash. Now, in the next transaction, they tell us that they sold 200,000 shares. So they're going to resell some of these treasury stock back into the market, and they can do that. They could just be like a normal investor, buy their own stock out of the stock market, they store it in this treasury stock account, and then they could resell it back out. They're allowed. So how do we remove it? Well, they told us that when we resell those 200,000 shares, assume FIFO. So cash will be debited for 200,000 times $7. If we remove the shares according to FIFO, we go and say, well, what were the oldest shares in our treasury stock? What were the first shares of stock purchased as treasury stock? Well, the 300,000 that cost $8 each. So when we credit treasury stock to remove these stocks labeled as treasury because they're being sold back into the market, we do it at 200,000 shares times the $8 per share. So we paid 1.6 million. We sold them for 1.4. So we took a loss, but we don't debit a loss account. We're not allowed to report this loss on our income statement. We debit retained earnings. Okay, we bypass the income statement and we just go right to retained earnings and decrease it. So two different ways of accounting for repurchasing shares. One, you retire them and then reissue them later. Two, you don't retire them and reissue them. So what happens in shareholders' equity? Well, let's focus on the shares retired area. If you go and make T accounts, which is what I encourage you to do, you say, okay, where did I start my common stock account at? 6 million. Well, in my first transaction, I debited it for 300,000 and then another 300,000. So I reduced it twice, but then I increased it by 200,000. So my common stock account will be at 5.6 million. Do the same thing with the paid in capital excess of par. 30 million is where you started. You debited it for 1.5, then you debited for another 1.5, so now you're down to 27 million, but then you credit it for 1.2. So its balance, 28,200,000. Paid in capital shares repurchase. Well, under the retirement, whoops, it's right there. There was a credit balance. So as I said, when we do our paid in capital section, that account will also be reported there. How about retained earnings? Retained earnings started at an $86,500,000 balance. Well, during retirement, we debit retained earnings $600,000. I think that was it. Okay. So, oh no, we did something else there. Let's take a look. 86.5. Okay, there's something I'm missing there that. Okay, they go on to tell us in part B, sorry about that. Net income for the year was 14 million for 2018, 15 million for 2019, and 16 million in 2020. So you have to make sure you add those net income figures to that original 86,500,000 and then subtract the 600,000 that was debited to that account during our journal entries. So under the retirement, your stockholders' equity would end up being 164,850,000. Okay. Under treasury stock, so you bought the stock with the intentions of selling it back into the market. Your common stock account does not change. Remember, here's our first journal entry. We have a treasury stock account. Second and third, there's nothing affecting our common stock account, so we reported at 6 million. Same with paid in capital excess of par. That wasn't affected at all. Retained earnings. The only time retained earnings was affected was right here. So we would still add net income from 18, 19, and 20, but minus the 200,000 debit. So in this case, retained earnings is at 131,300,000. But in this handling of the stock repurchase where you don't retire it, you have in a contra equity account, treasury stock, 2.4 million from that, 1,650,000 from that transaction, but then you decreased it by 1,600,000. So you must decrease stockholders' equity, less treasury stock, 2,450,000, because these stocks are still considered issued. They have not been retired. Now, the point of this is to show you that whether you retire the stock or you hold it as treasury stock, the effect overall on shareholders' equity is the same. Okay, so it's just showing you that it's your intention will put it in different accounts. And then they show you the alternative way of also reporting that. Okay, so, and all they did was combined all of these paid in capital accounts together and call them additional paid in capital. But you get the same answer. Okay, so that is problem 18-3. Okay, I just need to take a time out here. If I could find there we go. Okay, so our final problem we're going to look at is problem 18-5, and that's dealing more with our dividends. So let's take a look. Listed below on page 1080 are the transactions that affected shareholders' equity of Branch Rickey Corporation during the period 2018 to 2020. At December 31st, the corporation's accounts, this is as of December 31st, 2017, common stock, 105 million shares at $1.05, so 105 million. Paid in capital excess of par, 630 million. And then retained earnings, 970 million. So when it says in thousands, add 3 zeros. We need to prepare the journal entries that they will record from the transactions in A through F. So that's our first step. So I suggest you make T accounts, and one for each of these for now, and put their balances on the credit side, right? Because that's the side equity will reside on, the credit side. On November 1st, the Board of Directors declared a cash dividend of 80 cents per share on its common shares, payable to shareholders of record November 15th, to be paid December 1st. Please remember there are 3 key dates to a dividend payment. First is the declaration. I always go da 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 da, right? We are declaring a dividend. And on that date of declaration, the Board of Directors is promising to pay cash to the shareholders in the future. For that reason, they are creating a liability. When you promise to pay cash, you just created a liability. So on the date of declaration, November 1st, compute the amount of the dividend, 105 million times 80 cents per share. Debit retained earnings, because dividends are a payment of the earnings of the company. So we reduce retained earnings when we pay a dividend, 84 million, or when we declare it, I should say. Credit cash dividends payable, a current liability for the $84 million, where it will sit until we actually pay it. Now, November 15th is our second key date. It's called the date of record. And that's just the ownership cutoff date. Whoever owns the stock on the date of record gets the dividend. So there's nothing financial happening. So there's no journal entry. But then the date of payment is December 1st. So that's the date that they're actually sending the checks out to the shareholders of the date of record. So we will debit cash dividends payable, 84 million, and credit cash, 84 million. Let's take a look at the next one. March 1st, the Board of Directors declared a property dividend, consisting of corporate bonds of Warner Corporation that Branch Rickey is holding as an investment. So instead of paying cash, they said, we're going to send out a bond to you shareholders. Hey, a dividend's a dividend. The bonds had a fair value of 1.6 million, but were purchased 2 years previously for 1.3. Because they were intended to be held to maturity, the bonds had not been previously written up. The property dividend was payable on the shareholders' date of record, March 13th, and would be sent out, the bonds would be sent out on April 5th. So you still have your 3 key dates. Let's take a look. The first thing we want to do before we record the debit to retained earnings and credit to dividends payable is we must write up the property dividend to fair value or down to fair value. So when you're giving something other than cash, another asset, such as an investment in a bond, this company's holding an asset called investment in Warner bonds, and it's saying, hey, shareholders, we're not going to send you cash, we're going to send you this bond as a dividend. Well, we first write the asset up or down to fair value. So that's why in our first journal entry, we debit investment in Warner bonds and credit gain on appreciation of investment. It's like we sold it. So increase the value. Now we still own the bond. We haven't sent it out yet. So, but we still debit retained earnings and credit property dividends payable because we promised to pay an asset as of March 1st. But it's a property dividends payable. Date of record, we don't do anything. Remember, that's collecting dates. But on the date of payment is when they send the bond out to the shareholders. So debit property dividends payable for 1.6, now credit the investment for $1.6 million. So we write it up or down to fair value as of the declaration date. Don't worry if it changed value after that. So there's another type of dividend. Let's take a look at the next one. Oh, these are getting good. On July 12th, the corporation declared and distributed a 5% common stock dividend when the market value was $21 a share. Cash was paid in lieu of fractional shares, representing 250,000 equivalent whole shares. Let's see what happens here. Now, what's key is they declared and sent out. So this is a different kind of dividend. The first two we looked at, the company paid an actual asset it owns as a dividend. In this, they're sending additional shares out that are sitting in the safe of their own stock that hasn't been sold yet. This is a stock dividend. So it's usually declared as a percentage. So right now we have 105 million shares of stock outstanding. 105. We are, as a company, are going to pay an additional 5,250,000 shares. So we're sending out 5,250,000 additional shares. Well, kind of. We need to determine the value of those 5,250,000 shares. That's the total value of the dividend. When the stock dividend, the percentage is less than 20 to 25%, you calculate the value of those stocks as a dividend at their market value. So retained earnings will be debited because this is a dividend payment. But you're saying, yeah, but you're sending pieces of paper, shares of stock. Yes, but we still got to value it, and the rules are use market value. So 110,250,000. Now in the problem, they tell us the fractional shares of 250,000, okay, they're going to send those out as cash. So how much cash are they actually going to send to the stockholders? 250,000 times $21 per fractional share, $5,250,000. So the true value of the common stock that was sent out is $5 million, or 5 million shares times $1 par. Paid in capital in excess of par will be the 5 million shares times $20 a share, or $100 million. So since this company said we're not going to send fractional shares out, shares less than one, we're going to just pay those in cash, you have a little bit of a cash component and then the additional shares being sent as a dividend. So this just increased the number of outstanding shares of stock the company has, and it also increased paid in capital. It's like they sold them. They didn't. They just sent them out as a dividend. You have to keep this in mind. On November 1st, the board of directors declared another cash dividend of 80 cents per share, payable to the date of record, November 15th, and then ultimately December 1st. So again, now be careful. When we did this calculation back on November 1st, 2018, there were only 105 million shares outstanding. Now there's 110 million. 105 million plus the 5 million additional shares that were sent as a dividend. So you calculate this cash dividend on 110 million shares times 80 cents per share. Debit retained earnings 88 million, credit your cash dividends payable. Then no entry on the date of record. When you pay the cash out, debit cash dividends payable 88 million, credit cash. January 15th, the board of directors declared and distributed a 3-for-2 stock split affected in the form of a 50% stock dividend when the market value of the common stock was $22 a share. Okay, just give me a second here, because I'm looking at this going, So let me try to get my, come on. There we go. Just give me a second. Okay, sorry about that. The paid-in capital excess of par threw me off there. So they said we're doing a stock split, but essentially they said, no, it's a 50% stock dividend. So now we have another stock dividend. This time it's above 20 to 25%. It's 50%. And this is now considered what we call a large stock dividend. So how many new shares of stock will be sent out? 110 million times 50%. The current amount of shares outstanding are 110 million. The company's sending out 50% or 55 million more shares as a stock dividend. To calculate that, we use par value to determine the value. How much do we debit retained earnings? I prefer retained earnings. So debit retained earnings, 55 million, credit common stock, 55 million, because you sent them another 55 million shares. It's just that the FASB says value those at par value because it's a large stock dividend. And the final transaction, let me see if I can get this, curses, let's see. Okay, well, is another 65 cents per share cash dividend declared November 1st, 2020, date of record November 15th, payment date December 1st. So to calculate the value of this dividend, how many shares of stock are going to be receiving this cash dividend? The original 105 million plus the 5 million more shares that were sent out as a stock dividend, remember 5%, and then the additional stock dividend of 50% or 55 million. So 165 million shares will be getting that 65 cents per share. So debit retained earnings, 107,250,000. Credit cash, 107,250,000. I'm sorry, it's just not, see, it's gonna, if you can see me, there we go. So we'll do that to try to get it to be a credit. There we go. So you're still debiting retained earnings for the dividend amount and crediting cash dividends payable. We just can't forget about those additional shares of stock that we keep adding. Date of record, no journal entry. Payment date again, debit dividends payable for the amount of the dividend, credit cash. Okay. Now, in the second part, they ask us to prepare comparative statement of stockholders' equity for Branch Rickey for the 3 periods. Amounts in thousands, so eliminate the first 3 zeros. Net income was 330, 395, and 455 million for each year. So remember, a statement of stockholders' equity, we usually have a column for each major component of stockholders' equity. There's our common stock. Common stock starts January 1 with 105 million balance. We then increased it during 2019 because of a common stock dividend, 5 million. Then we increased it again for this 3-4-2 stock split that was affected in the form of a stock dividend, 55 million. So the final balance of our common stock account is 165 million. And if you've been keeping T accounts and updating as we did journal entries, you would see that. Additional paid-in capital starts at 630 million. During 2019, we added another 100 million due to the stock dividend. Now, your book likes, or your author likes to decrease paid-in capital for large stock dividends. I'm not going to. I'm decreasing retained earnings, like I told you. So paid-in capital is at 730,000. The most activity over the past 3 years was in retained earnings. Take a look. Starts at a $970 million balance. Net income for 2018, $330 million. The company reduced retained earnings for $84 million in dividends. In 2019, it reduced retained earnings for a property dividend of 1.6. It reduced retained earnings for a common stock dividend of 110,250. It increased net income for $395,000, and it decreased because of retained earnings because of a cash dividend of $88 million during 2019. So going into 2019, 1.411,150. We're going to decrease it for another $55 million, add net income of $455 million, and then subtract 107,250. So our final balance in retained earnings would be 1,703,900. Okay, so then if we get an overall, okay, so there's our total shareholders' equity where it started. We added net income, subtracted dividends, added net income. This balance is 0. Okay, that stock dividend has no effect on stockholders' equity overall. We added net income, subtracted this cash dividend. So ultimately, our total stockholders' equity at the end of 3 years, $2,598,900. So that was a great problem to illustrate the different types of dividends and their overall effect on the stockholders' equity by doing a stockholders' equity statement. So please take a look at all of those. If you have any kind of questions, as required, you are to post them to the discussion board.